Got a tax planning strategy that's appropriate if you plan to retire early. Real life planning scenario. Got that and more coming up. My name's Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. Recently, I'm changing some of the details because everything's confidential, of course, but the scenario is the same, and it's a pretty incredible tax planning strategy that applies to those of you that plan to retire early or are retiring early. You may find yourself in a very similar or the exact same situation. We do tax planning here. We do comprehensive financial planning here, looking at all 6 areas of your financial life. Those 6 areas, one of those is tax planning. Yes, we do tax preparation. That's different from tax planning. Tax planning is that pause between I got my return done, but I haven't filed it yet. Is there anything that I could do to make it better, to improve it? So here's the scenario. Married couple, he's 66, he retired a couple years ago, right before 65, conventional, worked corporate job and retired, and about the time that he could get on Medicare, so he's been retired just a little bit. I think he turned 67 this year, and started collecting Social Security right away, around $3,000 a month. She, however, went semi-retired about the same time, and she's much younger. She's 62, I think turning 63 this year, and semi-retired meant left the normal job, and now she's got contract income, so it's considered self-employed. His Social Security is about $3,000 a month. What she earns self-employed part-time is about $3,000 a month. So, and they can make it work. Debt-free, they've saved up a lot for retirement. They're in a strong financial position, and they live frugally. They're satisfied with that amount of income. Cash flow's tight, but it all works for them. So, couple hints then, if you're reading between the lines here, she's not yet eligible for Medicare, he's on Medicare, and because she's self-employed, she doesn't have any a kind of group health insurance to be on. So, we've got them set up, we've got her set up, buying health insurance through the marketplace, healthcare.gov. And when you do that, you might know that you've got to input what you expect your income to be for that year, and that determines if you get any advanced premium tax credits that lower your monthly payment for your health insurance premiums by giving you a tax credit in advance. And then when you do your tax return, where was the income? Where did we expect it to be? And then it trues up from there. And then the last thing I'll tell you before I get into the strategy is when I got the return from our fantastic preparers, our CPAs, but before planning, when I got the return, they owed about $1,000 on their federal return. And they owed it because in her contracting business, things were actually good. They were strong for her. And so her hours were up a little bit more than expected. She ended up making about $5,000 more than what they had expected. Further, they had declared what their income was at a time when they weren't fully calculating in what his Social Security cost of living adjustment was going to be from 22 to 23. And so even though I provide guidance with that because we do planning, they for Affordable Care Act or healthcare.gov reasons, they said our income is going to be here. And when I got the return, their income was about $5,000 more than what they said it was going to be. So they owed taxes. Well, one of the other things that I had been coaching them on was, listen, just in case, because she had said, well, listen, I'm self-employed, I can control my income, and we can make all this fit from a budgetary standpoint. We've got cash in the bank as well, should we need it. So we'll make sure that our income's at that level. And I said, that's fine. However, when you're working with our health insurance team, I would suggest using an HSA eligible health insurance plan. And that might cost a little bit more than a normal high deductible health plan, but an HSA eligible one, just in case we need to contribute to an HSA to get that income back down to where it needed to be. Why? Because there's a couple interesting things about this. It's not just her income, it's their family income that counts towards that income limit. And it's not just the taxable portion of Social Security, it's the gross amount of Social Security that factor into that calculation. We see a lot of people that reach out to us saying, I'm on healthcare.gov and I owe a lot of money, and why is it? Well, it's because when you put in income, you were just thinking your income, not your household income, not your joint tax return. And also, you were just looking at your tax return number, your adjusted gross income. You weren't including the non-taxable portion of Social Security. So All right, so I take a look at the return. Their income's about $5,000. Some of you know where I'm going with this. Okay, I had prepared you for this. Let's max out your HSA. And we built the return as if she was going to max out her HSA. And she's over 55, of course, so she can put in the extra $1,000 of catch up. That creates over a $4,000 deduction on the front page of their tax return, reducing their adjusted gross income, reducing their income, and it moved them from having a $1,000 amount due to getting a small refund or approximately breaking even, because that got their income down in line to what we were expecting. But here's the other thing. This is the strategy gets better. Their income then is below a level where they could get an extra tax credit for saving up for retirement. And you might say, well, wait a second, they're semi-retired. I know, but she's been contributing to her single K because she's self-employed. She's got self-employed income, not a lot, but has been contributing there as well. So that was another lever that we could say, well, if your income was too high, we could contribute more to your single K, do a profit share contribution, something like that, and that could get your income down even lower. But we'd gotten their income down to where it needed to be. I already mentioned cash flow was tight. So we funded the HSA and so on, but she was getting the maximum retirement savers credit because she'd put in more than $2,000. I think she contributed $3,000 to retirement. So they were in the 10% threshold of credit on the first $2,000. So they were getting a tax credit of $200. However, they could get another $200 tax credit if he contributed $2,000 to retirement, to a retirement account. You might say, wait a second, why would he do that? He's already retired. Yeah, I know, but they're eligible for this extra tax credit, something that you should be doing anyway, saving up for retirement. And because their income was already as low as it needed to be, we could take $2,000 and put it into a Roth IRA for him, take the money right back out the next year or whenever they needed it, but get an extra $200 in a tax credit on their tax return that you wouldn't need to repay. You don't need to claim that as income. It's a free $200 from just playing the shell game, moving from some dollars from cash or somewhere else, I'll just tell you in a second, into his Roth IRA, and then any growth on that's tax-free. There's no required minimum distribution, and technically, because he's already had a Roth IRA for at least 5 years and age 59 and a half, he could withdraw the money right away. So we were able to take advantage of that. That moves him from about break even to a little bit bigger refund. And then lastly, I've told you a couple times that cash flow was tight. And this is normal if you're going to retire early and you're really watching your income so that you can manage your premium tax credits like I talked about. There's this conflicting incentive. You are early in retirement, you're young, and you want to go out and enjoy retirement and spend, but as you do so, you've got to be careful about how high your income is. Otherwise, you're going to have to pay a lot for your health insurance. This is why you need planning, because cash was tight, and in order to fund the HSA and fund a Roth IRA, we could pull it from savings. I told you they had a little bit built up there, but that was going to infringe on some of the things that they were really hoping to do. They had a couple of vacations planned. They're going to visit one of their kids in New York and do some other things. So they didn't really want to do that. Well, where else could we get the money from? Well, from his working career, he'd been saving into an HSA. He was on a high deductible health plan during the last kind of stage of his working career, and he'd been saving into his HSA. And out-of-pocket expenses, as they came up, he just paid them. I told you he's been on Medicare, Part B for a couple of years. He was just paying that. Dental bills, they were just paying that. We did the math, and there was about $6,000 of out-of-pocket expenses that he could have used his HSA for, used it, but never did. He just paid out of pocket. So therefore, we had about $6,000 that we could reimburse them out of his HSA. Is that taxable? No. So it does not change this calculation for this year or anything else. Does not mean they'll have to get less premium tax credit or having a higher adjusted gross income. No. He can reimburse himself from his HSA. That gives them some cash flow that they can then fund her HSA and get a tax deduction, and fund his Roth IRA and get a tax credit. Just an unbelievable thing. As I was working and collaborating with the CPA who did the return on this, I honestly texted in Teams as we were kind of developing the strategy. I love comprehensive financial planning. It is just amazing. So in this scenario, if you retire early, where are you going to get your health insurance from? And by early, I mean before 65. Likely from healthcare.gov. And if you do that, likely you want to see, how can I get my income as low as possible so that I can get some advanced premium tax credits and pay a little bit less for my health insurance, but maximize, the quality of life and my lifestyle. So balancing all of that takes careful, proactive planning with your CFP. So work with your certified financial planner on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K. WiseMoneyShow.com. You can find us there as well, or send us an email, info@Korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.